Good morning, good afternoon, good evening. Let's start with the next topic, that is farming income. In specialized return, we have already learned about the estate returns, the descendants final tax returns, right? So let's start with the next topic, that is farmers. In farming income, so if you are a farmer or if your client is a farmer and earning some incomes from farming business, then we are going to use Schedule F on your 1040 form. Okay, so here what is covered, like what all things are going to be included on Schedule F. Schedule F, you can just simply compare it with the Schedule C. Schedule C is a business income, right? Same way, whatever income you are earning from the farming business, and that is ordinary, which is like day to day you're cultivating, harvesting, agriculture related income, and expense related to that will be included on your Schedule F. So let's see what are the inclusions and exclusions. What things are included on Schedule F? It will include farm product, it's farm product raised for sale or product bought for resale. Okay, if you are buying the seeds and cultivating it in your own farm and selling that crops, you are earning the income, then it is your farm income. Okay, amount for cultivating, operating or managing a farm, whatever amount you are incurring for cultivating, operating and managing will be included as an expense of your farming business. Okay, gross income for operating a stock, dairy, poultry, fish, truck, right, and operating the plantation, range and orchards, right? For apple there are orchards. Over there in US they have a lot of orchards over there, so through that they have a lot of income. So that income they are going to show on a Schedule F. Okay, then we have livestock, which is held primarily for sale. Remember this thing, we are going to have some question on this. If it's a livestock which is primarily held for sale, my business is only selling and raising the cattles, right? Then that will be my livestock. That will be my ordinary business, I can say. And then inventory of Schedule F will be there. So livestock will be considered as a inventory in Schedule F. All right. If it's my normal cattle, like my main business is just agriculture, growing crops, and in that I have 2-3 cattles who help me in some activities at the farm. So that will not be my livestock. That is not my inventory. That is my asset. Okay, here inventory, when it will be included, the livestock will be only be included as an inventory if it is primarily held for sale, right? We are raising the cattle and then selling it. What things will be excluded? In Schedule F, we are not going to include any income which the farmer is earning from sales or disposition of assets. What are the assets? Land or any depreciable improvements, depreciable farm equipment. Okay, so this assets, if there is a sale of this asset, this will not be included on Schedule F. But when we dispose it off, we are going to include it on 4797 form. All right, and in that also there are two parts. If it is held, the property, the depreciable property, farm equipment, building and truck, livestock or in trade business, raised livestock which is used in trade or business, right? All these things are, if they are raised or if they are disposed of, right, then just remember the forms, like we learned about the asset which fall under 1231 property, right? Capital gain 1250, right, and 1245. Do you remember this? We have done it previously. So this all things will fall under 1250, 45 and 31 type of property. So whenever you are going to dispose them off, you are going to file form 4797, and in that there will be two parts. Part 1 will include a sales of livestock where no deduction of expense during the live selling expense are allowed. During the life of the livestock, right? If there are expense to maintain that livestock, to maintain that cattle, that will not be allowed. And if there is a sales of livestock, it will go in the part 1. If it's a depreciable property, here you can see depreciable improvements are there, farm equipments are there, truck, building. So if those are depreciable and if it is held for less than 12 months, then it will go into part 2 as the ordinary income. This is most important, guys, because people get confused when this type of tricky questions are is asked in the question in the exam. See, if your depreciable property is held for 12 months, it will go in the part 2 and it will be considered as a ordinary income. Remember this thing, the usage, the holding period, if it's 12 less than 12, it will considered as an ordinary income in the part 2. If it's a livestock, right, or if it is held for more than 12 months, I can say, right, it will go on the part 1 of 4797, and there will be no deduction of expense for maintaining the livestock. Okay, so this was about what is going to be included in Schedule F and what is going to be excluded from Schedule F. So here you will find there is a little bit bifurcation over here. If the farm product is raised for sales or crops and livestock, okay, it's a day-to-day business. So simply it will go to Schedule F. If farm product bought for sales, crop and livestock, see, either it is raised or either it is bought and then resold. Both are our ordinary income, or business income, I can say, the farming business income. So it will directly go to Schedule F. But if the farm product which is not held primarily for sale, but it is used in the business, right? Farm equipments are there, the tools are there, all the buildings, improvements, all things that are used in the farming business, they are not primarily for sale. Okay, that will go to your 4797, that is sales or disposition of the asset. Okay, next is if the sales happens, the sales reduces due to some weather condition, right? In farming business, the weather is most important. So if the sales is reduced due to some weather condition, or you incurred a loss, or if there is a sales but you want to show it in a previous year, or you want to pay a lesser tax, right? Then what is the criteria, what is the remedy for that? If your business meets all the following conditions, right, then you can postpone the reporting of gain from additional animal until next year. For example, in usual business you were selling 3 animals, but in current year you have sold 5 animals. So the additional 2 animals which you have sold, you can report the gain in the next years. You can postpone the reporting of gain for the additional animals under next year. So what is the criteria? The principal trade or business is farming, right? They should fall under the definition of farming business. They should use only cash method of accounting. Accrual method, if they are using, they are not going to fall under this. Third is usual business practice would not have sold. Normally, if the business is just crop selling, okay, but due to some weather conditions or some things which are happening, due to that they need to sell the extra 5 animals, which is not a usual business for them, right? Yeah, their usual business is just growing crops, but selling that extra 2 was an not ordinary business. So it should be sold. See, if instead of the crops, if the business is, the ordinary business is purchasing and selling the kettles, then this provision will not fall. But due to the some weather conditions, if your business is farming, if you're using cash method, if the animal which is sold is not in an ordinary course of business, and if federal government designates that area as a eligible assistance, okay, government will just declare that area for the government for as a federally declared area, I can say. All right, next is crop insurance and crop disaster payment. If there is a loss of crops due to weather condition, and if the farmers are receiving the insurance proceed from the insurance company, right, they used to insure that their crops and everything. So when there is a loss due to some weather condition, and if the insurance company is paying them the proceeds, then what they can do, they can report the insurance proceeds as an income until the year following the year of damage. Means if the damage is happening in 2021 and you are receiving the proceeds from insurance company in 2021 only, so you have an option to tax this proceeds in year 2022. So next year you can include it as an income. But there are some conditions. The farmer must use cash method first. Second, they should receive the insurance proceed in the same year. So if the loss is happening, damage for the crop is happening in 21, then they should receive the proceeds from insurance company in the same year. Okay. And then third is normal business practice of the farm is the sale of crop. So here your usual business is sale of crop, and your main business is getting damaged, main business is getting having a loss, and for that you are receiving a insurance proceed, right? Then only you can postpone the inclusion of the insurance proceed into next year. All right, these are the three conditions which needs to be fulfilled. Next is income averaging. Allocate the income to 3 prior year. Only farmers engaged in the farming business, right, they can allocate the income into 3 previous year. So this is income averaging. There will be just one theoretical MCQ based on this topic, that individuals, partners and shareholders, only this 3 can use the income averaging method. Means what? They can just allocate the income in 3 prior years. Okay. Next is estimated taxes. Do the farmers have to pay the estimated taxes? Yes. If the gross income is more than 2/3 of from the farming, along with the farming, they have some other businesses, right? And if that business gross income is more than 2/3 from the farming, okay, estimated taxes not applicable for them. Estimated tax is not applicable. Pay entire tax liability on 1st of March. Okay. If your farming income is higher, then estimated taxes is not applicable. You have to just pay a single payment, that is on 1st March. Remember, here the deadline is 1st of March and not 15th April or 15th March. It's 1st of March. Remember this thing. If the gross income is up to 2/3 of from the farming, estimated taxes to be paid on 15th Jan, single payment. Okay, how much you need to pay as an estimated tax if you owe, you are owning a farming business? It's 66 2/3 of your tax dues, right? Or 100% of previous year tax liability, whichever is lower. All right, estimated taxes. In case of farming income, do we need to pay estimated taxes? Yes, but it will depend on whether the gross income is less than 2/3 of farming or more than 2/3 of the farming income. Okay. Next is gross income from farming. Now this gross income, what it will include and what it will exclude. Gross income from schedule F, that will go to 1040, plus gross income from rental farm. If you're renting a farm, see, if you're renting a normal residential or non-residential house, it will go on schedule E, right, on your 1040. But if you're renting a farm, you will have to file 48354. Gross farm income, schedule E. Gross farm income, schedule E, 1040. Gain from sales of livestock used in the trade or business. This all are the inclusions in farming income. Gross income from farming. Gross income from farming. Okay. What are the exclusions? If you are paid the wages to the farm employee, that will be excluded. Income from contract of grain harvesting and hauling with the workers and machines furnished by the taxpayer. Gain from sales of farm land or depreciable farm land. So these 3 things will not be considered like in calculation of gross income while calculating the estimated tax. So if there is any sales of any asset, depreciable property, that will not be considered as a gross income. See, only hardcore farming business income will be considered. Okay. So that's it for the farming income. In farm, don't forget to solve MCQs. They are very simple. You will just have the calculation that whatever is the gain, whether it will be shown on schedule F or on 4797. This type of MCQ will come. Second, the sales of cattle and sales of crop proceeds. From this, there can be one questions. Okay, so total 3 questions might be there in the farming chapter. Okay. Let's start with the next, that is rental property. In rental property, if you are earning any income, you will have to show it on a schedule E of 1040. Okay. Now here there is one criteria. If your home is vacant, right, and it has been rented for less than 15 days. If it is rented for less than 15 days, then it will be deemed as a personal property, means rental income will not be taxed. Only for a whole year, if you have rented only for 15 days, then it will be deemed as a personal property and it will not be taxable. Okay. Then depreciation, repairs, expense will also be not deductible. Income is not taxable. The depreciation, repairs will also be not deductible. Only the municipal tax, mortgage interest will be deductible, and that too on Schedule A, not on Schedule E. No Schedule E will be filed if you have rented your home or property for up to 15 days. But if you have rented the property for more than 15 days, right, then you have to make sure whether it is used for personal or whether it is not used for personal. How you will calculate that? Just compare the 14 days, whether it is used for 14 days for personal or 10% of the total rented days. For example, I have rented the house for say 100 days. So 10% of 100 is 10 or 14, whichever is higher will come 14. So I'll see whether I'm using my house for personal use for more than 14 or less than 14. Okay. For example, if I have used the personal house for say 10 days, then it will fall under the second condition. Okay. For example, I have used my house for say 15 days for personal use, and it will fall under the first condition. And if it's fall under the first condition, means you have used your home for personal use for more than this days, then it will go under the first criteria, means it will not, the income will not be taxable, there will be no deduction, and it will be considered as it is used fully for the personal. But if it is not used for personal use for more than the criteria which is mentioned over here, then you have to just simply allocate the rental income, right, and all the expenses. So personal uses, which is used by the owner of family for up to less than fair rent. For example, I have an Airbnb, right? And if I'm charging say 10,000 per night for other people's, and for my relatives and employees, I'm charging amount of say 4,000 or 5,000, right? Then in that case, it is less than the fair rent, right? But if rented for more than fair rent, then it is not a personal use. But for example, I'm charging 10,000 to other people also, and I'm charging to my family members for 10,000 only. So it's the same, right? The fair, it's more than or equal to the fair rent, then we will not consider it as a personal use. Then unit is available for use, right? Unit is available and not actually rented, and not a days of rental use. See, what happens now? If, for example, I am having one property, right, a well-developed property. Now what will happen? My friends and families, they will ask for some like 2 days or 3 days for conducting any parties or some events or something. And if I'm charging them, right, money, and which is same as that which I'm charging to other people's, right, same 10,000 I'm charging to both, then I'll consider those rented days as not a personal usage, but I'm giving them as a free. You can conduct your event, everything. So that is the personal usage days. Okay, so that will consider over here in the calculation. And if it is more than that, then you will allocate the rental income and expense between the days, like what are the personal days and what are the rented days. Got it, guys? This was not included earlier. Since 2020, this topic has been included. Okay. Next is rental income and expense. What all things will be included in your rental income and expense? First is advance rent. If you receive any advance rent, you will include it in the income. Second is security deposit. Now, if in case you are receiving security deposit, if it is refundable, then you are going to exclude it. If it's non-refundable, we are going to include it in our income, right? If there are some expenses which is paid by tenant directly, for example, tenant is paying the municipal taxes directly, tenant is incurring some repairs for the home and he is paying it, then on behalf of the owner, the tenant is paying, right? So that will be included as an income, as a rental income. And if it is not paid by tenant, then it will be excluded from the income and it will be considered as a rental expense. Got it, guys? Next is property or service in lieu of rent. So whenever instead of paying rent, if a tenant is providing you some services, just take the FMV of the property or services as a rental income. Okay. For example, I have a rental property. I have given it on rent to one of the person, and that person is preparing my tax returns. But instead of paying me rent, he is not taking the fees also. So I can say it is a payment in the lieu of rent. So for me, what I'll do, whatever is his service charges, I'll include the FMV of that as a rental income in my books, okay, on my schedule E. Then rent from personal property, if it's an equipment or the vehicle, if you're renting it, right? And if the rental activity conducted for profit, then go to the schedule C. Not for business, then just take other income minus expense in the AGI. Okay, if your main business is only renting the personal property like equipment, vehicle, just you will show it in the business schedule C. Okay. Next is rental expense. What all things will be included that are directly related to the renting of the property, that is advertising, cleaning and maintaining of the property, like utilities, right, electricity bills and everything if it is there, taxes, interest, commission for collection of rent, travel, transport, fire and liability insurance, this will be included. Okay, and maximum 12 months is deductible if the liability insurance is paid in advance. Then depreciation, it will depend whether it's a residential and non-residential. We have done this, right? 27.5 years is there and 39 years for the non-residential. Non-residential means the commercial property, I can say. Repairs are there, improvements are there. And if your expense incurred for the property is 2500 or 200 or maybe 5000, then it will be capitalized. It will not be allowed as an expense, but it will be capitalized as an asset on your schedule E, right? Mandatorily, you will have to capitalize the expense. See, there will be one question from this. They will give a list of expenses and the amounts. They will say, like, they will ask that how much will be capitalized and how much will allowed as a deduction, allowed as an expense, rental expense on your schedule E. So there will be one question from this. Mandatorily, you will have to capitalize 8 items, that is HVAC, plumbing, electrical, escalators, elevators, fire protection alarms, security, gas distribution. So this 8 items, just remember it. There is no way, but you have to just remember this 8 items. If there is anything related to this 8 items, it will be capitalized and it will not, even if it's $5, even if it's $2, even if it's $2,000 or $2 lakh, any XYZ amount. We are not going to check the limits for this assets, but it's going to be capitalized by default. Okay, so rental income, rental expense we have done. Next is additional consideration. What are the things which needs to be keep in mind for rental property? If you are receiving a local benefit, if you're paying a local benefit taxes, right, it is not deductible but added to the basis of property. Local benefit taxes means what? For example, this is your property, just beside around your property you have developed a sidewalk, right, to like improve the texture of the property or make it convenient for the people living in the property. So sidewalks, for that if you have paid any taxes, right, for taking the benefit, then this will not be deducted on your PNL as a tax. It will be added to the basis of the property, cost of the property, it will be added. Okay, if you have a vacant rental property, right, if you're holding a property for rental purpose, ordinary and necessary expense may be deducted, right, if it's a vacant, right, but ordinary and regular expense like maintenance and cleaning expenses are there, so that expenses can be deducted even if your property is a vacant rental property, even if you have not rented it for a single day, but it is ready to be rented. Okay, then there is a loss due to vacancy, that is not deductible. See, due to vacancy, if I am incurring any loss, so that is not deductible now, right? Next is uncollected rent. If you're using accrual method in your box, and if you have a bad business debt, if unable to collect the rent income previously recorded, see what happens now, you have recorded as a bad debt in previous years for non-collection of the rent. Now in current year you are recovering that rent, right? So in that case, and if you are using accrual method, then only you might have deducted the bad debt. So this will come only in the accrual method of accounting only. So now if you're recovering that bad debt, it will be considered as your income. Okay. If you are using cash method, bad debts are not at all allowed as a deduction. Cash method, there is no bad debt. Okay. Not rented for profit. Taxpayer cannot deduct expense more than the rental income. Right? If you are not you're renting the like it's a non-profit organization, and if you're renting and not collecting the rent or minimal rent you are collecting, right, then whatever are your expenses, that will only be allowed only up to your income. So not for profit, I can say. If you have rented your property, whatever income you have collected, it can be xyz amount, it can be very minimal amount. So up to that amount only the expenses will be deducted. Whatever is your extraordinary expense will also not be carried forward. All right. Property change to rental use. If the property is changed from personal to rental, then what you are going to do? You are just going to divide the expense between the personal and rental in the year in which it is getting converted. Okay. No deduction for personal use portion will be allowed. Whatever is your rental use, for example, for 200 days I have rented the property and 165 days I have used for the personal. So it's simple. Whatever expense you have incurred only for this 200 days will be allowed as a deduction from your rental income. You cannot deduct your cleaning and maintenance and everything for this 165 because it was used at that time for the personal purpose. All right. So this is about additional consideration. Next is limits on rental losses. Now, if you are incurring a loss in a particular year, then how we are going to treat that loss and whether it's going to be carried forward or not. So first of all, whatever loss you are incurring, allocate it to the at-risk basis, and then we are going to check the passive activity limits. What do you mean by at-risk? At-risk means what? Whatever cash and adjusted base of the property is there, add the borrowed amount, if any, to take that asset, to acquire that property. Up to this amount, right, you can deduct your losses. Whatever is the remaining, you can carry forward it to the next year. Okay, so first you are going to apply at risk, means up to the cash and adjusted basis of property plus amount borrowed for use in the activity. For example, if you have borrowed the amount to acquire the property, right? So add these two, you are at risk till this both amounts. So up to this both amount, you can deduct your losses. Now, what do you mean by passive activity? So this is a rule where normally what happens, Schedule E is your passive activity, right? Schedule C is not a passive because you are constantly involved in the business. That is Schedule C. So that is the ordinary, I can say. But Schedule E is your passive activity. All right. So what IRS allows you that passive loss should be set off only against passive income. But here there is one exception. If you have a rental loss, means this is a passive activity, right? Then you can offset up to 25,000 from your ordinary income. Normally it is allowed only from passive income, but up to 25,000 you can offset it against the ordinary income. Okay, so both conditions to be satisfied. First is what? More than 50% work is related to real estate business. First, more than 50% of your business should be real estate business, and participation will be there, should be there. More than 50% work is related to real estate business plus participation. Next, you are participating for more than 750 hours of material participation in real property trade or business. You are constantly involving yourself for more than 750 hours. Okay. Then what you can do is you can offset your $25,000 of loss. Remember, only up to 25,000 can be set off. Plus, taxpayer and spouse both should be actively participating in the business. Now, what if the rental loss is more than 25,000? See here, it's 25, not 2500. Okay. If your loss is more than 25,000, then what you will do? You will compare whether your modified AGI, right? You should know that what is your AGI, modified adjusted gross income. AGI, you know, right? All the incomes and then reduce some deductions. All the incomes and deductions, you get a AGI. From that AGI, you are going to add the tax exempt interest, tax exempt dividends, right? Tax exempt items you are going to add. So that is your modified AGI. Got it? So if your modified AGI is more than 1,50,000, then there is no deduction. If your modified AGI is up to 1 lakh, then the whole 25,000 will be allowed as a deduction from your ordinary income. Against your ordinary income, you can set off the 25,000 of your passive activity loss, that is rental loss. Rental loss up to 25,000 you can offset against your ordinary income. But if your modified AGI is more than 1 lakh, then what you will do, out of this 25,000, you are going to reduce 50% of 1 lakh 50 minus modified AGI. Whatever is your modified AGI, see, if it is above 1 lakh 50, you are not going to get any deduction. If it is less than 1 lakh, you are going to get the deduction. What if your Maggie falls between 1 lakh and 1 lakh 50? So you will just take 150 minus whatever is your modified AGI. You will take 50% of it and you will reduce this 25,000 reduction, and then whatever is the amount will be allowed to be set off against your ordinary income. Got it, guys? So this was all about your rental income and expense, and this topic is important, guys. Just remember, there will be one or maybe two questions from this topic, and that will be straight away of 2 marks. So whatever is the practical questions that you can allocate as a 2 marks, and there will be straight away question from this. Just remember the limits, just remember the calculations, solve the MCQ, and you'll be able to easily clear the question based on that topic. Okay, so we have done the rental and the property. All right, so that's it for today's session. Tomorrow we are going to start with the last topic of the chapter, that is retirement plan, and which is very important. The limits are very important in that. There is no way to learn the concept, but just have to remember the limits in the retirement plan account. Okay, so yeah, that's it. Thank you, guys. Have a great day.